There's a lot of real estate data out there, and there's a lot of providers, but what do you actually do with that data? How do you decipher it once you put it all together? I'm going to walk you through why we built GemHaus and how GemHaus helps consolidate all of the data that you are getting from multiple different tools and putting it together to create the total picture for you so that you no longer have to guess when you are researching investment properties. So this is everything from cash flow to operating expenses, a total full property pro forma. Most investors making decisions based on trying to piece together tons of different information, maybe from Zillow, MLS, AirDNA, rent estimates, spreadsheets, stuff from their brokers, trying to look at operating costs from property managers. And by the time that they're done, they're very overwhelmed and there's still something that's missing. So before I dive fully into this, a little bit of background about me. I used to run a full service brokerage. I built and scaled and managed over 75 million in real estate assets. They were mostly short-term rentals. I sold over 150 million in real estate personally, and then I started building GemHaus before exiting the management operations business. So I was underwriting deals daily, and I realized how many people were not doing it properly and losing a lot of money that way. So by the end of this, you'll know how I personally evaluate investment properties, what numbers actually matter, and how to use GemHaus to do it in minutes instead of piecing together information from many different places. So to start off, when I look at a property, there's basically about 6 different things. I mean, there's a lot of different things I look at, but there's about 6 different things that I really am looking at when evaluating the property. The first thing is purchase price, looking at income, the operating costs, definitely financing, comparable sales, and what kind of return that I am getting. So I'm going to pull up GemHaus and I'm going to walk you through how I do this myself. Okay, so if we're looking at this property that was sent to me in Phoenix, it looks like a great house. This is on Zillow. It's for sale. 4 bedrooms, 3 baths, 2,200 square feet, going for $789,000. It looks like there's some remodeling done. It's set up as an Airbnb. It's operated in the past as an Airbnb. So I'm going to go to GemHaus now and see if this is even viable, if this even pencils out. So you can either type in the address or copy the Zillow link and just paste it as so into the bar. The process is pretty simple. So it's going to bring in all the pertinent information about the property. You can see that it was built in 1979, shows a lot of square feet. There's garage, pool, there's a putting green, quartz countertops. It's going to bring all this information in for you. So if we go back to what we first look at, going to be purchase price. So they have it listed at $789,000. So we can scroll down and look at the estimated valuation. So GemHaus brings in all of the sold comps for this property. And you can see where it ends up on the range, on the meter. And the suggested price is around $349 price per square feet. So it's just a smidge under what they have it listed for. And these are the comps that were pulled and where it's landing amongst the comparable properties. And you can see all of the properties as well on the map, and you can click on them and it will actually bring you to the listing. So based off of the comparable properties, this isn't a bad listing price. This is pretty in line with the market. It's not overpriced. It looks like there was a tear down at $189 price per square feet, so it looks pretty in line with the market. So that's number one. we are going to now put in the amount of down payment in the assumptions. So right here you can see that it shows that there's going to be 20% down. It brings in the interest rate at 6.55% around today's rate. It's going to bring in the long-term rental estimate and the short-term rental estimates for the nightly rates and the occupancy. So I'm going to adjust this to 25%. That's how much I would want to put down. And you can see that all of the numbers update automatically. So as we scroll down, it's going to instantly show you what the projected numbers would be for a long-term rental and short-term rental. So looking at the long-term rental, it has a 3.8% cap rate, negative cash flow. The gross is at $37,000 a year. So what's really contributing to this negative cash flow? Well, if we scroll down, we can see the monthly payment for this purchase price would be $4,127 with principal, interest, property tax, insurance. So right now, with the high interest rates in the market, we're typically going to see a lot of negative cash flowing investment properties. It is what it is. You can find properties that do cash flow in this market, and you should definitely jump on them. So in this case, looking at it right away, I personally wouldn't say that this is necessarily a property that I would purchase, because there is too big of a gap between the long-term rental and short-term rental, which means it would be very reliable on the short-term rental. Now, if I were to put more down and we got it for less than this, then there might be potential to end up buying this. So if we look here, if we put down, see when it starts to become positive, around 50%, 51% for the long-term rent. So that is what you would need to make this property cash flow for the long-term rent. So now we're going to look at the operating costs to see where the net is coming from, the net income. So for this property, it's estimating at $31.52 for a long-term rental. Management fee is estimated at 9% at $284 a month. And property tax, $269, insurance, $105. These are things you generally can't change unless if you find a management company that will do it for less. Even if it's $100, $200 less, it's not gonna make the difference too much for long-term rental. So I'm gonna come back up here. I'm gonna change this back to 25%. To show you the short-term rental side. So as we look at the short-term rental, $1,000 cash flow a month is pretty decent. Over 7% cap rate. The gross income is estimated at around $89,000 a year. So I'm going to come down here and look at this. Okay, so there's management fee at 20%. For $1,400, property tax $269, insurance, consumables $187 a month. So that's like linen, paper towels, toiletries, items like that that have to be replaced that the owner pays for, and utilities. So it's bringing in what the electricity would be, water, landscaping, pool maintenance for this specific property. Now, I have a manager that can do this for 15%. So I'm going to update this over here. So at 15%, that brings down that monthly cost about $300. So you can see now the cash flow is even higher and the cap rate has increased as well. So I am going to now hide this and I'm going to look in the calculator and I'm just going to go through this and see, okay, down payment, interest rate, the loan term, closing costs, vacancy rates in here, utilities. Okay, I want to take a little deeper dive into the rental estimate. So it's estimated at $89,000 a year. Now, how do we look into this to see, is this exactly what I'm going to get? Am I going to get less or can I get more than this? So we've already looked at the sold comparables. Long-term rentals are here as well. Not too much of a spread for that. So now we're going to look at the short-term rentals. So we can see that the subject property is here. And we can see the other comparable properties in the area and what they're going for. And the median that's bringing in is at $7,024 a month. So as we can see, there's other properties that are going for $9,000 a month at $117,000 annual. That being said, there looks like there is room to produce more. We want to make sure though that this property is going to be in line with the other property's revenue if we think that it can do more, right? So this property right here, like it looks fairly standard. It doesn't look too different than like our subject property, right? But if we go to the property right here, that's at 16,000. Oh, guess that one's not listed on there anymore. We'll try this 10,000. So this one looks a bit more elevated than the property that we might purchase. So what does that mean? It means that if we're going to buy this property, we're going to need to spruce it up quite a bit to get the higher revenue. We're going to want to make sure that our management company is really good and that we can make this property shine just as much as a property that's producing $10,000 a month. So that being said, $7,467 is not bad. We'll be making $1,500 a month from our investment. That's a 8% cap rate, 8.8% cash on cash. It's not terrible, to say the least. And if we can get this conservatively a month, $7,467, we're at least in the clear. Now, if this property was producing, if its initial estimate was much lower and it was only clearing maybe $500 a month, I would be very skeptical to move forward because it would just be very tight. And you don't want to take those chances and roll the dice on property, then have to end up selling it because you couldn't long-term rent it after. So that being said, if I were going to buy this property, it would be specifically to rent it as a short-term rental. play, and that is it. In the future, once the debt has been either refinanced, if the rental market increases, then we can eventually convert it to a long-term rental. But this would be initially a play for just short-term rental. Okay, so these are the main factors that I look at when I'm initially underwriting a property. Now, if I want to get very deeper into the data, we're going to go into the comp lab. So, of course, when it comes to the solds, we're going to have our real estate agent negotiate to get, as good of a deal as we possibly can on the property. Long-term rentals, fairly simple, but again, going into the short-term rental data, we can get very specific now with bedroom count, bathroom count. Maybe I want to add a bedroom, maybe I want to add a bathroom to the house. That usually increases the nightly rates and occupancy rate. But for this sake, we're going to look at the amenities. So, what if we put a hot tub in? Actually, let's remove this. Clear. Okay, so if you look right here, you can see the market median right now is at 7,024. Now, what if we put a hot tub in? The properties generally get more because now the market median is at 8,800 a month. That's just by putting in a hot tub. So now, what else can we do that's going to increase the potential revenue for this property? Oh, okay, views increase a bit more. Obviously the properties all have air conditioning. This is in Phoenix. Okay, indoor fireplace increased it even a little bit more. Usually properties that have indoor fireplaces might be a bit more luxurious. This property, I wouldn't say is necessarily a comp. So you do want to look into the properties, into the data, because as though this is a 4-bedroom property in the vicinity, in the radius, might be similar square footage, but it definitely appears to be a much more luxury property. Okay, let's see. Let's get rid of the indoor fireplace. And I want to actually remove this as a comp because I don't think it's comparable to that property. And we're gonna get rid of the views because that seemed to be around the Lookout Mountain. These properties are generally a bit different. Okay, so I think that we could probably remove this property as well. Seems to be an outlier. And this one seems to be quite the outlier as well. It's on the mountain. Okay. Narrowing down the comparable properties, you're really just taking a look and seeing how close they are, just appearance-wise, at first, to your property. So this property, looking at it from first glance, is a lot more similar aesthetically to the subject property. So this one would be a pretty good comparable, and this one's making $9,750 a month. So what I'm gonna do is I'm going to use this monthly revenue amount. And we're going to go back to the report, and we're going to adjust that in the calculator. So let's see how much that changed it. So it went to about $1,500 a month to $33.98 a month. That's a big difference. It's a 10% cap rate, 19% cash on cash. We like that a lot more. So what I always say is when you first run the report, it's always going to give a much more conservative valuation throughout. And the reason being for that is because if you can't afford the conservative potential, then you shouldn't purchase the property. And that is what I tell everyone. That is my recommendation. Then you want to start looking in and seeing, okay, is there other properties on the market that are doing more? How do we get to more? So I just showed you that. So now say if I just want to go to see another market, and say I'm looking, that was in Phoenix, we'll do Scottsdale. We want to see how, maybe Paradise Valley is doing. And we're gonna look at the short-term rentals actually, because that's what we're doing. We're gonna click right around here. We're gonna look at 4-bedroom, 5 baths. Say minimum of 3, 10 guests. We'll do mile radius. Oh. Okay. So at a 2-mile radius in that location at the 4 bedrooms and 3 baths with at least 10 guest capacity, you can see what it brings in for this area. You can see every property that is listed. And you can generally just go through and take like a look. So there's properties that are doing $500,000 annually. And if you're an investor and maybe you want to fundraise and you want to maybe bring on a capital partner and you want to buy or just buy a luxury property in general, you can see how much you can really make from buying short-term rentals. This area is doing $200,000, $186,000. This one was only doing $69,000. Maybe it wasn't listed for the full year. But the market median is at $18,000 a month. So it's pretty cool to take a look at other markets and see how it's doing. And you can do that with a long-term rental as well. And you can run through and generally take a look at how other markets are doing to see if it's something that you even want to purchase in. If you're traveling to Florida and you want to take a look and see how Florida properties are performing, and you want something that maybe doesn't just rely on short-term rental numbers, you can take a look at that market and get a pretty good understanding, just a general overview of it, and then you can see, okay, if the general market is doing 5% in that location, this could be a decent spot for us to purchase our next investment property. And you can do that by exploring the map over here. So this cap rate is very low for Paradise Valley. It's at a 0.5%. And it's most likely because the property prices are so high in that location, and the rental long-term rental is not going to be sufficient towards the price of the property. But if we look at Tempe, there's a 4% average market rate. Estimated rent, $15.99. So this could be a pretty decent spot to maybe invest in. Can just generally look around on the market and see how other markets are performing. It gives a really great overview of top of funnel all the way down to the very submarkets that you're looking in. So that is how I would run a analysis pretty quickly. Of course, this is for demonstration today, but when I run a property on GemHaus, it takes a couple minutes just to run through it and look at the numbers. Now, when you're satisfied with a report, and say if you're a real estate agent or a lender, or maybe you want to send it to your real estate agent, you can then download the report. You can send them the link. You can even, if you want to, upload it into ChatGPT or Claude and communicate with your favorite AI and see if this is something that you want to move forward with. So that is what I have for you today. And I think what we can also discuss is the common mistakes that investors make and how to avoid them. So a lot of common mistakes that investors make today, they will use average rents instead of looking at the comparables. Damn it. So that's why it's important to look at all of the data, go to the comp lab, see all of the properties. They'll also ignore the operating expenses. It is so important to look at your operating expenses because that is going to be what you're paying every month. Management fees, utilities, insurance, taxes, maintenance. There's a lot that comes up when you are operating an investment property. So a lot of investors also just look at the cap rates. And when you just look at the cap rates, you're really missing out on the nitty-gritty cash flow and the net income. And then a lot of people don't compare the short-term rental to long-term rental. You want to know both. For a residential investment property, you want to be able to have a full picture of what you're buying. So very important to run both numbers. And a lot of investors just assume that appreciation will solve everything. But what if you go into a down market? Then that's not so much fun if you do that, and it doesn't end up solving the cash flow issue. So always take a very holistic approach when you're investing in your properties. Look at everything, run all the numbers, really take a look and deep dive with everything. So that is how you use GemHaus to run a full analysis. And that's what I do when I'm underwriting a deal to see if it's something that I would buy, if I would recommend someone to buy. When I was underwriting properties all the time for other investors, that is what I would look at. So if you have any questions, if you want to reach out, feel free to send me a message. Happy to run through a deal together with you. I hope this was helpful, and I would love for you to use GemHaus, give any feedback that you'd like, and I'll see you next time.